Picture yourself at 35 years old, staring at your bank account with exactly $39,000 to your name. Not in savings, not in investments. That's your entire net worth. Everything you own minus everything you owe. Meanwhile, your coworker who started investing at 25 somehow has $135,600 at 45. And you're thinking, what am I missing here? You've heard the advice 1,000 times. Just start investing. But nobody actually explains how to go from zero knowledge and limited money to actually building wealth. Here's the thing that's going to completely change how you think about this. The difference between financial struggle and financial security isn't about how much you make. It's about 10 years. Just 10 years. My name is Seb, and I'm obsessed with breaking down the money stuff that financial advisors deliberately keep complicated. I help people understand how investing actually works, without the industry jargon designed to confuse you. If you're tired of feeling left behind while everyone else seems to be building wealth, make sure to hit that subscribe button and give this video a thumbs up if you learned something that actually helps. By the end of this video, you'll understand exactly how to start investing today, even if you've never done it before. Before we dive into the step-by-step process, let's talk about why 36% of non-retired Americans have absolutely zero retirement savings. Here's the uncomfortable reality. It's not because they're lazy or bad with money, it's because your brain is literally programmed to fail at this. There's something called temporal discounting, which is just a fancy way of saying your brain values a $50 dinner tonight about 100 times more than $50,000 in 40 years. The difference between people who build wealth and people who don't has nothing to do with willpower and everything to do with understanding one simple mathematical fact. Time is worth more than money. Let's start with the math that changes everything. If you invest $500 every month at a 7% return, which is what the stock market has averaged after inflation, here's what happens. In 10 years, you'll have $86,545. Your total contributions? Only $60,000. That means $26,545 came from literally nothing except time and compound growth. But here's where it gets absolutely insane. In 20 years, that same $500 a month becomes $260,480. You only contributed $120,000, but you made $140,480 in growth. In 30 years, you're looking at $605,995. You put in $180,000 and your money created $425,995 on its own. Now let me show you the most brutal statistic in personal finance. If you start investing $500 a month at age 25 and continue until 65, you'll have $1,199,112. If you wait until 35 to start, you'll have $566,764. The cost of waiting those 10 years is $632,348. Think about that. You contributed $60,000 less by starting later, but you lost $632,348 in final wealth. That's not a 10% difference. That's losing 53% of your potential retirement. This is what nobody talks about when they tell you to start early. They make it sound like nice advice, but it's actually the difference between retiring comfortably and working until you're 75. Here's the thing. I know what you're thinking. $500 a month? I can barely afford $100. Let's talk about that, because this is where most people completely mess this up. They think investing is all or nothing. They see those big numbers and assume they can't participate unless they're putting away thousands every month. Let me break this down for you. If you invest just $100 a month at that same 7% return, in 30 years, you have $121,199. You contributed $36,000 total, and $85,199 came from growth. That's 70% of your money coming from compound interest, not from your paycheck. Your money is working harder than you are. Now, let's talk about where to actually put this money, because this is where the financial industry has been ripping people off for decades. You've probably heard about mutual funds with expense ratios and management fees and all this confusing terminology designed to make you think you need an expert. Here's the truth that's going to sting a little. According to research tracking thousands of actively managed funds, after 15 years, over 90% of professional fund managers underperform the S&P 500 index. These are people with MBAs and decades of experience and rooms full of analysts. And they can't beat a simple index fund that just buys everything and holds it. But they're still charging you for the privilege of underperforming. The average actively managed fund charges around 0.50% in fees. A low-cost index fund? You can get one for 0.03%. That sounds like a tiny difference, right? It's not. Let me paint you a picture with real numbers. If you invest $10,000 per year for 30 years at a 7% gross return, the low-cost fund with 0.03% fees leaves you with $944,608. The high-fee fund at 0.50%, you end up with $838,017. That tiny fee difference just cost you $106,591. That's 12.7% of your entire retirement account going straight into someone else's pocket. This brings us to the actual process of starting. Step 1. If your employer offers a 401k with a match, this is where you start. This isn't optional. This is literally free money. According to recent data, 96% of employers make contributions, with the average match being 4.6% of your pay. Let's say you make $60,000 a year and your employer offers a 50% match up to 6% of your salary. If you contribute 6%, that's $3,600, they give you $1,800. That's an immediate 50% return before your money even gets invested. You cannot beat that anywhere. But here's what's absolutely insane. 25% of employees don't contribute enough to get the full match. They're literally leaving free money on the table because nobody explained this to them in terms they could understand. For 2026, you can contribute up to $24,500 to your 401k if you're under 50. If you're between 50 and 59, you can add another $8,000 as a catch-up contribution. The money goes in pre-tax, which means it reduces your taxable income right now. Here's where things get interesting. After you max out your employer match, your next move is a Roth IRA. The contribution limit for 2026 is $7,500 if you're under 50. The difference? With a Roth IRA, you pay taxes on the money now, but it grows completely tax-free forever. When you're 65 and pulling out $100,000, you owe zero taxes on it. Think about it this way. With a traditional 401k, you're betting that your tax rate will be lower in retirement. With a Roth IRA, you're betting it'll be higher. Given that the government is running massive deficits and tax rates have historically gone up over time, the Roth starts looking pretty attractive for younger investors. Now let's talk about what to actually buy once your account is open. This is the part where people freeze up because there are thousands of investment options, and the financial industry has convinced everyone that investing is complicated. It's not. You can open an account at Fidelity, Schwab, or Vanguard with $0. Not $1,000, not $500, zero. Then you buy a total stock market index fund. At Fidelity, that's FZROX with a 0.00% expense ratio. At Vanguard, it's VTI with a 0.03% expense ratio. These funds own thousands of companies, the entire U.S. stock market in a single investment. Or you can make it even simpler and buy a target date fund. Pick the year closest to when you'll turn 65, and the fund automatically adjusts from aggressive, mostly stocks when you're young, to conservative, more bonds as you get closer to retirement. One fund, done. Here's the part that will blow your mind about staying invested versus trying to be smart and time the market. According to research tracking investor behavior, the average equity investor in 2024 earned a 16.54% return. The S&P 500 itself returned 25.02%. That's an 8.48 percentage point gap caused entirely by people panicking and selling at the wrong time or waiting for the perfect moment to buy. Let me show you what this looks like in real life. If you invested $10,000 in January 2005 and just left it alone through the financial crisis, COVID, everything, you'd have $71,750 by December 2024. If you missed just the 10 best days in the market during those 20 years, you'd have $32,871. Miss the 20 best days? Around $18,000. The difference between staying invested and trying to be clever is $53,750 on a $10,000 investment. And here's the kicker. 7 of the 10 best market days occurred within 15 days of the 10 worst days. If you're sitting on the sidelines trying to avoid the bad days, you're mathematically guaranteed to miss the best days too. This is where most people completely sabotage themselves. They wait for a market crash to start investing. They see the S&P 500 at all-time highs and think, it's too expensive now, I'll wait for a pullback. But markets spend the majority of their time near all-time highs. That's what a functioning economy looks like. Waiting for the perfect entry point is just another way of not investing. Look, here's the bottom line. You need to contribute up to your employer match in your 401k first. Then, max out a Roth IRA at $7,500 for 2026. Then, go back and increase your 401k contribution. Put everything in low-cost index funds and stop checking it every day. The account you open today with $100 will be worth more in 40 years than the account you open in 10 years with $10,000. This isn't about being perfect. It's about being consistent. Your first investment will probably feel awkward and uncomfortable. Do it anyway. The median net worth for someone under 35 is $39,000 total. By 35 to 44, it jumps to $135,600. That tripling doesn't happen by accident. It happens because compound interest needs time to work. You can keep waiting for the perfect moment, the perfect amount of knowledge, the perfect market conditions. Or you can start today with whatever you have and let time do the heavy lifting. Your future self will thank you.